corporate and government debt has been a popular choice for many investors who've lost faith with stocks. But with everyone buying this debt, has the fixed income field gotten a little too hot for profits? Let's pose that question to our think tank. We have two experts with us. Ed Perks, he is a portfolio manager for Franklin Templeton Investment Funds. His fund has outperformed 93% of its peers in 2009. And we have James Camp. He is a fund manager for Eagle Asset Management. His firm offers 5 fixed income investment programs. Gentlemen, welcome to Bloomberg Taking Stock. Good to have you with us.
Thank you.
Good James, so with the situation that yields seemingly are so low that we get these debates about whether they'll go lower, is this the time to be adding to a fixed income portfolio?
Interesting you mentioned that. Today we actually touched the low yield on the 10-year for 2010. Our thesis about bubbles or over-allocation really goes back to 2 years ago when the whole crisis showed itself in earnest. At that point, fixed income couldn't be given away, including commercial paper and very high-grade short-term assets.
It seemed as though the commercial paper market was even closed for a while.
It was, in fact, seized up and it had stopped. So what happened at that point is capital necessarily found the cheap asset, which was historically as cheap as fixed income has ever been. For folks like Eagle Asset, that was a tremendous buying opportunity as the big players had to unwind. So that was a rational trade. And in fact, that trade, roll the clock forward, has been extremely successful for most investors. Most investors at the retail level are still underallocated to fixed income, 19–20% in total, even now. The question is less bubble-oriented because fixed income has a finality to it. It's a uniquely different asset. Capital found a way to go to the cheap asset. Are we stretched in valuations? In some sectors we are. I would argue the Treasury market, barring real aggressive quantitative easing, probably is. High-grade municipals, high-grade credit, certain CMBS commercial real estate, absolutely still some value left, especially if you know the sectors to play in.
Ed, what's your thought about this?
Yeah, I would agree with a lot of what James just had to say. I think kind of post-crisis, late 2008, early 2009, we in fact had a major move into corporates, and at one point got up to 70% of our Franklin Income Fund in fixed income, which is a pretty high level. But roll that forward, as James was alluding to, that was the right trade at the time. That was the cheap asset. Tremendous total return opportunity from investment-grade corporate bonds in particular. High-yield corporate bonds as well in 2009 drove tremendous performance. But today, as we sit, and our process is a bit more kind of looking at the entire capital structure of a company to find relative value either within a given company's capital structure or across an industry or sector. And more that process is leading us to a more balance, including more equity in some companies.
I'm glad you used that concept, though, total return, right? Because that's something that investors, particularly when they're looking at fixed income, they've got to really understand, James, it's the total return that counts. And you've got to make the distinction between buying an individual bond and buying an individual bond fund. Can you explain a little bit about that?
I agree 100%. And more importantly, perhaps, is after-tax total return. Let's remember, there are very few favored tax asset classes that are tax-favored still. Dividend-paying stocks and high-grade municipal bonds are extremely attractive.
And even some municipal bonds, you got to be careful because with the Build America Bonds program, those bonds are taxable.
An interesting point, because that program is in fact supplanting a lot of the pure muni issuance. So you have a confluence of demand increasing because marginal tax rates likely to increase. Another supply coming online, taking pure municipal issuance away. But the total return concept, as you mentioned, is very important, especially now. We're going to start seeing yield vehicles created. I'm already seeing these in my work. The retail investor needs to know the 10-year Treasury yields 2.5% to 2.4% right now. Add a reasonable spread to that for the yield number, which is not the return, and that's a fair and reasonable capital market assumption. Anything marginally or materially different than that, something's going on, and they should look a little closer.
In other words, don't just jump at the big number that someone's shoving in front of you to tell you that this is a high-yielding product. There's no free lunch anywhere here, right, Ed?
Absolutely not. And hopefully that lesson was learned in the prior crisis, because that, I think, if you look at some of the product that had developed from 2005 to the crisis in 2009, a lot of that was driven by high kind of sticker yields or return opportunities, but in reality, investors weren't looking and doing more work to understand actually what they were buying into.
Has this focused investor attention on dividend-paying stocks then?
I think in many instances it has, and in particular when you're looking at companies that are established global players in a given market, have tremendous balance sheet strength. In many instances, these companies are sitting today with more cash on their balance sheet than total debt. So, we are finding opportunities there. Companies that have attractive dividend yields, more importantly, have an established track record of dividend growth. Now, throw in some companies in a position to buy back shares occasionally. We think a lot of that can build and be a nice additive thing for shareholder value.
Talking about fixed income versus stocks, well, maybe not versus. Maybe we should talk about them complementary. This is our think tank. We have Ed Perks. He is the portfolio manager for Franklin Templeton Investment Funds. His fund outperformed 93% of its peers in 2009. James Camp is a fund manager for Eagle Asset Management. His firm offers 5 fixed income investment programs. James Camp, calls. A lot of companies have put the call out that they're redeeming their bonds. They were paying high rates of return. They've said, why should we do this? We'll call the bonds in, pay off the coupon at 100. You can now do what you want with the money, and we'll just reissue new bonds, but at a much lower rate. So what are people supposed to do with the money that they receive? What do they do with that cash?
Well, it's a great question, and one of the reasons in portfolio construction you tend to, at least we did, as we saw the interest rate regime falling and continuing to fall in what we call a deflationary tug of war with inflation, is make sure we had structural securities that didn't do that. One of the big nemesis out there now is the mortgage market, and I'll allude to why that matters in prepays. We have the average mortgage rate in this country still at 6%. A lot of people are holding high coupon mortgage securities. These dollar prices may be 110, 112 cents on the dollar. These can be redeemed immediately if homeowners were able to refinance. Therein lies the dilemma. Most of these homeowners are unrefinanceable, so there's this locked up capital at the consumer level that at some point has the risk of being redeemed, either by government fiat saying we're going to allow Fannie and Freddie to take everybody down to par and pay these things off, or otherwise you have to look at premium securities in your portfolio and realize reinvestment risk is there. More importantly, taking less yield initially to have a certainty or a better structural asset going forward. At this point, it's okay to be patient. Bond markets move in episodes. Right now, if I have a lot of money being redeemed and I have to reinvest, I'm going to be as cautious as I can with capital preservation first and foremost, modest income second, and realize that my purchasing power may not actually be compromised if, in fact, as the Fed is suggesting, we are in a 0.5 or lower core inflation rate for the next 2 years.
Well, talk about this prepayment peril. I mean, that's the last thing a bond investor wants to hear about, at least when you're investing in mortgage-backed paper. Prepayment, that's going to cause a lot of problems. When you look at where to put the money, you mentioned dividend-paying stocks. What kinds of stocks are we talking about? Johnson & Johnson, Vodafone, what kinds of companies?
Yeah, I think actually that's one of the things I think is more constructive about the opportunities in dividend-paying stocks today, is that historically we were maybe confined to fewer sectors, like utilities or major pharmaceuticals. And today, in fact, you look across a broader range of different segments of the economy, and there are opportunities across the board. Energy companies, even consumer-based companies
Southern
like
Company,
PepsiCo.
that's one of the companies
we
I know
still
that
do
you
like
follow,
utilities.
right? Okay.
We have a little over 10% of our fund in utilities, so there's still nice opportunities there, really well aligned to our overall investment objective for Franklin Income Fund. But once again, more breadth in terms of different segments of the economy, even something like technology, where you now have leaders like Intel, like Microsoft, yielding above the market average and above,
about
and above the
3.5%.
Exactly, and above the 10-year Treasury. I think it was interesting that just last week, Microsoft was in the corporate bond market with I think just under about $5 billion worth of offerings across some staggered maturities, 3s, 5s, 10s, and 30s. They sold $5 billion at an average weighted cost of about 2.4%. with an average maturity of 11 years. That company has a stock that has a dividend of 2.8%. So, clearly quite a disparity even within individual companies in terms of the yield you might find in their common stock versus the yield offered in even their longer dated corporate debt.
James, when you look at fixed income right now and you look at the possibility of earning higher returns by taking on more risk, is it risk that you want to take on right now, or are you getting the push from investors to say, look, I can't live with the yield so low. I need more. And you've got to educate them a little bit about the risks.
And therein lies part of the manager's job. It is not a time for us to be aggressive with risk taking. It is an educational process. And as I mentioned, 2008 seems like a distant memory. To have liquid portfolios, high credit quality, no credit impairments, and a lot of ample ammunition at that point was a very good thing for fixed investment. As we've seen these massive flows into the large fund complexes, inevitably, as risk appetite increases, and it will year 2, 3 down the road, that unwinds, that creates buying opportunities. But I quite agree, dividend-paying stocks are a tremendous opportunity. Some of our Eagle products, in fact, do that. They look at the capital structure, like many managers, and say, are the dividend stock fellas in a better position today than we are, or are we in a better position in the capital structure? 2 years ago, it was an easy trade for fixed income. It is less so today. So be careful with your bonds.
Now, James, you also brought up inflation, and I want to bring that into the conversation because, indeed, if you are an investor that doesn't owe a lot of debt and has some cash, deflation might actually work in your favor because your dollars are going to go further. Is that a theme, do you think, for the year or no?
I think it has to be a theme for the next couple of years, and that's one of the things that I think as a nation we're grasping with. Purchasing power is increasing despite relatively low yields and returns going forward. Asset valuations, real estate, for example, is still in a dire situation, in my opinion. We have a 15 or 20% correction coming there, barring continued massive intervention at the Fed and Treasury. So it is a real rate of return that we're looking at. From a real perspective and a real rate of return and asset allocation, bonds are fair. They're not as screaming as they were a couple years ago. Dividend-paying stocks, to me, barring another leg down in stocks, and we have to remember, stocks don't always go up because we've had this nice recovery, though they seem poised. Corporate balance sheets are in terrific shape. The upgrades to downgrades in high-grade corporates for the last 2 quarters is finally above 1, and it's been well below that for the last 2 years. So 2 asset classes worth taking a good look at for the next couple of years.
All right, I'm going to say that it's not stocks or bonds. It's complementary. That's why we've got you. I want to thank you, gentlemen, very much, shedding some light on what's going on. James Camp, Ed Peaks, thank you for your insights.